The snowball effect in dividend investing refers to the compounding effect of reinvesting dividends received from different stocks and/or ETFs. When you own a stock or ETF that pays a dividend, you have the option to either take the dividends as cash and to go spend the money on bills or maybe on something fun. Or of course, you have the option to reinvest that money back into the original asset by buying more shares of the same exact stock and/or ETF. If you choose to reinvest the money you earn from the dividends back into more shares of whatever stock or ETF is already paying you dividends, you are going to receive even more shares because you're buying more. And then because you bought more shares, you're going to be receiving more dividends, which then you can reinvest and buy even more shares. Now, over time, this compounding effect can lead to a significant increase in the number of shares that you own and the amount of dividends that you receive. Now, the more shares that you own, the more dividends you're going to receive. And the more dividends you invest, the more shares you'll own. This creates a cycle of compounding that can grow your wealth exponentially over time. As a result, the snowball effect is often considered one of the most powerful wealth building tools available to investors. Now, in this video, we're going to talk more about the snowball effect and dividend investing. And I'm also going to show you maybe the easiest way to build a massive dividend snowball with a relatively small amount of money to start. Now, let's say you're a new dividend stock investor that doesn't know exactly which stocks or ETFs to buy. But you know one thing's for certain, you want your dividend snowball to start growing as fast as possible. One of the most popular and maybe one of the best ETFs that pretty much every single dividend investor loves is the SCHD ETF. Now, the SCHD ETF is an exchange-traded fund that seeks to track the performance of the Dow Jones U.S. Dividend 100 Index. The fund is managed by Charles Schwab Investment Management and has been around since around 2011. The goal of the ETF is to provide investors with exposure to high-quality U.S. large-cap companies that have a history of consistent and reliable dividend payments. Now, the Dow Jones U.S. Dividend 100 Index consists of 100 U.S. stocks that have a track record of paying dividends over the past 5 years, with a focus on companies that have a consistency to increasing their dividend payments over time. So not only do all the stocks inside of the SCHD ETF pay dividends, but they all have a tendency to raise their dividends over time, which is only going to help when it comes to the compounding. Now, one of the key benefits to investing in SCHD is the focus on high quality companies with a strong track record of paying dividends. This can provide investors with a reliable source of income and a potential hedge against inflation. Now, some more stats about SCHD. SCHD's current trailing 12-month dividend yield is around 3.58%. The annual payout for one share of SCHD is around $2.64 as far as the trailing 12 months go. Now, maybe the most important thing, the 5-year growth rate for SCHD is 15.56%, which gives you an idea of how fast SCHD's dividends have been increasing over the last 5 years. Now, to give you more of a visual look, if you look at the past history of all the dividends paid by SCHD over the last 10-12 years or so, you can see that not all that long ago, on a quarterly basis, SCHD was paying anywhere from 25 to 30 cents per share per quarter. Now, fast forward just a few years, and SCHD is paying well over 50 cents, even over 60 cents, up to 70 cents per share per quarter. So for all the investors that invested into SCHD just a few years back that were earning around 30-40 cents per share per quarter from SCHD are now earning just about double that. So now that we have an idea of what the dividend snowball effect is and one option of many of an investment vehicle to build this massive compounding dividend snowball, we now have all the information to plug into the dividend calculator. These numbers can of course change depending on the individual investor, but with a relatively small amount of money to start with, I'm going to show you exactly the numbers and how the dividend snowball can take any average person and make them filthy rich over the long term. So with a starting principal of investment of $25,000 invested into SCHD, and with the annual dividend yield of around 3.5%, which is more or less what SCHD is offering right now. Now, including the expected annual dividend increase for SCHD at around 15.5% and an annual contribution of $12,000, which means this investor in theory would be adding around $1,000 more into SCHD every single month, with the dividend payment frequency quarterly and DRIP turned on. meaning this investor is going to be reinvesting, of course, all the dividends paid by SCHD, because again, that's how the dividend snowball can take place, because of course, that's how the dividend snowball's growth can be supercharged. Now, years invested, I put 30 years. Again, this can depend on your age. If you're 15, if you're 30, if you're 45, you're going to want to put in a different amount of years invested, of course. But for this example, let's stick to 30 years and see the numbers it gives us. So the table is calculated and the dividend snowball is already starting to grow. Year 1, year 2, you're seeing the annual dividends go from $8.86 to $14.80. 1 year later, the annual dividends are already up to $2,100 plus dollars. Now, one thing to keep in mind is the yield on cost. Because SCHD, for example, has such a fast pace of the dividend growing, your original yield on cost is going to be skyrocketed, which means you're going to be making more and more money on your original investment. Now, just 5 years in, your original investment is now worth $113,000 plus dollars, and the annual dividend income is around $4,000 per year. 10 years in, the investment is worth $359,000. with over $12,700 in annual dividends. Now, by years 15 and 16, this investor would officially become a millionaire, with around $900 to $1.1 million in principal and around $33,000 to $40,000 in annual dividend income. By year number 20 years in, just with a relatively small amount of principal invested, this investor would have a portfolio value of $2.3 plus million, with over $83,000 in annual dividend income. Year number 25, this investor would have over $5.7 million, with over $200,000 in annual dividend income. And by year number 30, all the way at the end, you can see that the snowball has grown to $13.7 million, with just under $500,000 per year in dividend annual income. Now, one thing that's very important to understand when it comes to compounding, over time, the longer the investor sticks with it, and of course, adding more money can speed things up, but either way, time in the market is going to do its thing. And by year 5, 10, 15, this portfolio, this snowball, is really going to take shape, and the principal and the dividends are going to absolutely explode. This just goes to show that any average dividend investor can create their own destiny if they understand the basic fundamentals when it comes to investing and stick to a strategy that works. If you enjoyed this video, make sure to please drop a like on the video and subscribe to my channel for more content like this in the future. Thanks as always, guys, and I'll see you in the next one.